Hi, everybody, and thank you for joining us today. Before we introduce our guests and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by the presenters are their own, and however true, funny, or interesting they may be, they are not endorsed by Advice Chaser. Please do not act on any information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box. The presenters will answer these queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure somebody reaches out to you after today's event. We want this event and experience to be as educational as possible. So please don't hesitate to ask for further clarification or expansion on the material that you see today. And with that, I would like to introduce to you today's presenter. With over 20 years of experience as a financial professional, Erwin Matthews has practiced as a CPA with a Big Four public accounting firm, operated a tax practice, and now advises individual and small business clients. His career as a financial advisor started with American Express Financial Advisors, where he became a franchise owner and branch manager. He built a successful branch with 6 advisors while managing a $30 million practice. He achieved many accomplishments in his 10 years with the company, and in 2004, he transitioned his practice to Merrill Lynch as a senior financial advisor. With Merrill Lynch, he managed his personal practice and was a partner on the $50 billion corporate and institutional advisory team, the largest team in the company. In May 2009, he became an independent and launched One Source Advisory, which represents the firm that brings clients all the key services and expertise from one source and allows him to deliver a more comprehensive service to the client, including leading edge and unbiased solutions to the client's most pressing needs. And with that, I leave it to you, Erwin.
Awesome. Thank you, Samantha. Welcome, everyone. And so today we're going to talk about tax tips for life events. And really just want to kind of think about as we go through our progression in life, there's a number of things that may happen, but particularly today, we want to focus on events such as marriage or divorce, children, having kids, education planning, retirement, savings, and investing. And then lastly, we'll talk about a financial checkup after we've talked about how life events may impact your taxes. So first, let's look at married or divorced clients. So some tax tips or ideas you may want to consider. A lot of questions that are common is, do we file married or do we file married filing joint versus separate? Well, it depends. A lot of it depends on your personal situation. It may make sense to be separate. For instance, if you're trying to qualify for any type of student loan repayment, income repayment programs, one spouse may have a lower income than the other, so it may make sense to do a separate filing just to benefit from something like that. Capital gain treatment also is impacted by your income levels. So those may be reasons where you may want to consider filing separate versus married. Also looking at your itemized deductions. In some states, you can still itemize and get a greater benefit versus using the standard deduction. So I would ask you to just take a second look at that as well. Next is if you find you have a situation where you got a split home, dependent exemptions, who's going to claim the children. That impacts a lot of the credits, and we'll talk about that in the future in terms of the options that are available for you. So married or divorced clients, there's a lot of flexibility there. Discuss it with your professional because there may be some opportunities that you may be missing. And if you're fortunate and exciting to have children, of course, there's education that we need to be concerned about. New parents, congratulations. There are a lot of tax tips and options available for you. Children, well, they benefit. You have the child independent care credits available. If you know and you're going to have kids, and you had kids before the end of the year, there's an opportunity to adjust your withholdings. Maybe talk to your HR department and just talk about your new dependent now that you're going to have and how that impacts your taxes or what kind of credits that will be opened up to you at tax time. There may be an opportunity to take advantage of it, adjust the withholdings, and reap the benefits sooner than later. Consider the pre-tax dependent care options that are available through your employer. So if that life event occurs for you and your spouse, talk to your benefits office, see what's available, but also talk to your professional, your tax professional, and talk about what options do you have today before the end of the year that could really benefit you and help you save taxes and definitely increase your take-home pay. If you're thinking about education for the kid, the 529 education saving plans are available. These are tax deferred and can be tax-free if the money is used for education. So those are increased opportunities available for you and your spouse. Education credits, as we discussed earlier, these kids are now ready to go off to college. There are going to be additional tax benefits that you can enjoy there as well. There's an additional child tax credit available. And then lastly, the health savings accounts, medical expenses. If you are able to contribute the maximum to your health savings account, HSA accounts are there also known as. These could be additional opportunities to save taxes. So a lot of options there. The key point here is if you have the life event, talk to your HR department, think about the tax savings options available for you. Married or divorced. So we talked earlier about filing joint versus separate, dependent exemptions, itemized deductions for your state, and then looking at options for filing separate. We spoke about the student debt and then the zero capital gain treatment potentially. So retirement. So all of us are probably working, and at some point this is going to be a life event. So one of the things we want to really focus on is, are you maximizing your opportunities? Most employers today have a 401k plan, and a lot of them contribute to that plan as you do. So in some cases, some employers will contribute up to a percentage of your income based on what you contribute. But at a minimum, you should try to do as much as you're comfortable contributing. For each dollar, one example, for each dollar that you contribute to your retirement plan, you technically should be saving yourself for 30 to 30 cents on the dollar in taxes. Essentially, you're putting that money away tax-free. You're not being taxed on it while it's saving, so it should grow faster for you. The other key component here is if your employer can matches, that's free money. So that's almost like a guaranteed rate of return on your investment. So that's almost a must do. So when we talk to clients, we talk about contribute up to the maximum that your employer will match, because that's additional dollars that you get for free. If you find yourself having prior retirement accounts from a previous employer, there's the rollover option, which is a tax-free way to move your money from a former employer retirement plan into your own IRA. And that gives you greater flexibility, but also allow you to contribute to save, allow you to continue to contribute and save for retirement. If you have an IRA, you can also review converting it to a Roth IRA, which is a tax-free way to grow your money, as long as you leave it there for at least 5 years and be 59 and a half before you access the money. So that's another great opportunity. And then if you find that you're over 50, the laws allow you to do catch-up provisions, so you can put additional dollars into your retirement plan to catch up for what you may not have been able to do at previous ages. And then if you're 55 or older, you can start taking penalty-free 401k distributions. This is a really big one for people who are considering leaving the workplace. They've got a substantial nest egg saved already. They're over 55. You can actually start taking that money penalty-free. Remember, it's still taxable, so you have to do your tax planning around it, but it won't be assessed any types of penalties because you're younger than 59 and a half. So savings and investing. So as you are about saving and you're investing your financial plan, one question that comes often is, Erwin, what's the difference between taxable and tax-free investing? So it really depends on your tax situation. Let me give a life example. So certainly with interest rates being higher, this is a really good time to be thinking about tax-free investing. Here's a 4% taxable investment. If you're in a 35% bracket, it's probably going to cost you, it's going to net you 2.6% because you have to pay taxes on that interest that you earn. If you have a tax-free investment that's yielding 4%, it's essentially the same as you earning 6.1%. And all I'm really doing is showing you the tax impact of a tax-free investment, how it could yield you a higher rate of return based on your tax bracket. And I'm using this in this example, it's assuming you're in a 35% bracket. So you take the 4%, the rate of return that it's paying, but if you divide that by 1 minus your tax bracket, because you're not paying taxes on that money, it's equivalent to earning 6.1%. So would you like a 4.1% taxable investment or 6.15? So do the math. Certainly the tax-free investment may make the best option for you based on your taxes. Again, we talked about the Roth conversions. Again, you want to do an analysis based on your tax bracket. It may make sense for you to convert your existing IRA into a Roth IRA that would help you save the money long term. Obviously, you have to pay taxes on the conversion, but if you've got enough time and age, you can certainly overcome that, and the growth of that account would be tax-free. Tax loss harvesting. That's essentially if you find that you've got a sizable portfolio and you've got some losses in the portfolio and some gains before the end of the year, you could probably sell the gains and offset those losses. Because as you know, capital gain losses are limited to $3,000. So we talk about if you can sell some of the gains to offset a greater loss, it may be a way to harvest some of those losses and benefit you from a tax standpoint. If you are a real estate investor or you own rental property, Schedule E may be something that's familiar with you regarding your tax return. So passive activity rules come into play. Depending on your income, you may or may not benefit from any losses that you experience. However, if you can demonstrate that you are a real estate professional, and this is based on time and effort. So if you're putting in enough time, and the IRS says that you have to meet a certain threshold of hours to meet that definition of professional. And obviously, if you have a license as a real estate professional, you can qualify. The whole point here is that you don't have the limitation on any passive losses that may occur as a result of owning real estate. So look into that as well. And then also, if you are pretty active in that real estate world, 1031 exchange is another tax provision that allows you to defer the gain on some of the gains of the properties that you may sell. This is really big for people who buy and sell real estate. They call them real estate flippers or investors. And then lastly, capital gains. The long-term capital gain treatment is 20% versus the short-term gain rate, which is based on your ordinary income. So if you're in the 28 or 30% bracket, short-term gains are going to be taxed at that higher bracket versus if you hold investments for a year plus, you can qualify for the long-term capital gain treatment. Just something to keep in mind. And so let's take a step back. I know we talked a lot about the tax tips, but if you can imagine your career as it is today, I don't know where your salary is, but let's just look at what your career earnings may be. And so this is kind of an average that I see. Someone getting out of college or who's been in college and they've got several years of experience. Let's assume you're making $100,000 a year and you've got 30 years to work. Or if you're making $250,000 a year and you got 20 years. You potentially are going to make at least $3 million on the low end to $5 million on the high end. So the real opportunities, it's really not about what you make, it's about what you keep. So if you think about your career earnings, you ultimately will be a millionaire. $1 million plus will come through your pocket. Let's talk about what that really means for you in terms of your financial plan. So lastly, we want to talk about that career earnings picture that we just discussed. When you talk about how to maximize, how do we keep more of that, Erwin? I would answer with, you got to think about doing overall financial planning. I know tax planning is our topic today, but when you talk about your earnings, your career earnings, your life earnings, you want to really think about it in the context of your financial planning. So I want to just summarize with your financial checkup. Do you know what your financial net worth is? Take a minute, do an assessment of all the assets that you own, your house, your car, anything of value. You own a business, if you own artwork, you own personal assets as well. Do a total there, subtract from that any liabilities, credit card debt, mortgage debt, auto loans, and come up with a net worth. You normally call that as your financial scorecard. You want to look at that every year and make sure it's growing. and it's growing by way of you reducing your debts, increasing the return on your investments, etc., or your assets. That's how you grow your net worth. But at least know what it is and monitor that year in and year out. Cash flow planning. These are things that you want to focus on daily as you get about your 3 to 5 million of your career earnings. How do you manage it best? Cash reserves. We want to make sure we keep at least 2 to 3 months of your monthly expenses set aside in a local bank or a credit union somewhere close to you where you can access to it. Another way of managing your cash flow is managing the debt. Make sure you are responsible around your credit cards, mortgages, etc. And then another area of planning is your protection planning. We're all working with the assumption that everyone's going to be healthy. No one has any unexpected events occurring in life, but as we know, that's not true. So protection planning needs to be part of any planning, tax planning, financial planning that you're doing. Protect your income. The most important asset that you have today is your ability to generate the income that you're making. And then life insurance. Do you have loved ones that rely on you? What would happen in the event of a death of a spouse, the death of both of you? Do you have kids? Do you have family that rely on you? How would those individuals be impacted if that type of event occurred? Auto insurance, okay, and is mostly something that all of us address because of the laws, and certainly the home insurance, you want to factor that in. And then lastly, your long-term care. Just like income protection is most important while you're working years, long-term care is equally important when you retire. We all know that if you live long enough, you probably got a loved one who's experienced some type of long-term illness before they expire. Our research tells us that people will spend at least 4 to 5 years in some type of long-term care situation in retirement. So you got to protect your retirement nest egg. And then we talked again about tax planning, continue to focus on maximizing your strategies around your wealth creation, and then investment planning. Know if you're focused on your shorter, longer term, and then retirement. All those things need to be in sync. And then finally, your estate planning. You've done your planning. You've done extremely well. You've managed your 3 to 5 million of your career earnings. You've got a great nest egg. Your kids are grown. Everything's worked out for you and your spouse or you individually. Now it's time to think about legacy. What kind of legacy will you leave for your family? What happens if you were to pass tomorrow? Are your affairs in order? That's the estate planning component of your plan. Essential documents we talk about most people will need is a will, beneficiary designations that shouldn't be on any type of IRA or life insurance, power of attorney. Does your situation demand a power of attorney? What happens if you get sick? Who handles your medical decisions, financial decisions? A lot to think about. So taking a step back, and again, in summary, your financial plan is important. Tax tips are critical, but overall, you want to do that in the context of your financial planning. It's been a pleasure. Thanks for having us today. Look forward to speaking with you in the future.
Thank you for that. That was very informative. And if you have any questions, feel free to add them in the chat. Otherwise, we will get ready with the outros. On behalf of Advice Chaser, we want to thank our speakers and their organizations that have worked with us to bring this webinar today. Thank you so much for attending, and look for an email soon with a link to the replay of this event. You're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anybody we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you on another webinar soon.